Markets across the world have been characterized by volatility over the past quarter. Having said that, emerging markets have done pretty well this year. And now, as we enter the fourth quarter, we've just had the first Fed rate cut in more than 4 years. Sean, why don't we get right into that? Is it what you were expecting? And do you expect the Fed to cut again this year?
I think the underlying trend has actually been the growth in the US economy that has probably been better than expected. We were probably a little bit surprised that it was 50. The interesting thing is the reaction in the market. So equities came down a little bit. The 10-year actually went up a little bit. Initially, people started to put on weak dollar trades, but halfway through the session started to close them out. So I would say, Ben, it's been a mixed reaction in the market. So one of the confusing issues with the 50 basis point rate cut was it done because the Fed is worried about the US economy? But in the speech afterwards, the Fed was pretty clear that the US economy is in a pretty good state, that they were just really, getting a little bit further because the overall rate is very high relative to, what they think is the normalized rates at around 3.25 to 3.5. So, and we don't have a meeting in October, and the next meeting is now because of the election after the election in November. So there's quite a period of time. And the Fed did say that going forward that, don't expect 50 basis point cuts. That wouldn't be the norm. So our view is we've got 2 more rate cuts through the end of the year. If the data is weaker, we could have 50 in November and then 25 in December. And we then should have rate cuts all the way through to June 2025, where the rate would then be in the range of 3.25 to 3.5. So, this is the start. We're not sure of the speed of the rate cycle coming down from where it was at 5.25 to 5 down to 3.25 to 3.5.
Now, how may this cut and future rate cuts, we may get over 1% by the end of the year, impact the performance of emerging markets, particularly the regions, Asia and Latin America? And how will it affect your portfolio allocations and positioning?
Yeah, so there are 2 types of rate cuts. One is normalized, and 2 is if things are in trouble. And we really have to differentiate that bit. Because if we're having rate cuts, a slow, measured path, and economic growth is good, then that's actually incredibly positive for the rest of the world growth, and particularly emerging markets and Asia. But if we're cutting rates because the economy is really weakening, but ends up being stronger than the rest of the world, then that's very, very negative for emerging markets. So in this case, our base case is that the US economy is actually in pretty good shape. The Fed are talking about 2% growth this year, 2% growth next year. It's probably actually stronger than the European economy and the Japanese economy. So you can't say at the moment that global growth is stronger than the US growth going forward, despite the rate cuts. But within emerging markets, and particularly the rate-sensitive markets, it gives the ability of a number of central banks to cut rates. And I expect we'll see in the next couple of days, certainly within the next month, Ben, about 8 to 10 central banks cutting rates. So this really is a turning point for Asia. But it's not a big one-off, it will be incremental. So, we're still a big believer that Asian growth is picking up. Pre-COVID, it's much more normalized cycle than it is in the US because the aggregate demand wasn't helped by fiscal policy and handouts. And this gradual rate cutting really does help over the next year. So positioning wise, we've already pre-positioned. So a lot of the regional funds, we've already taken some capital out of the markets that have done very well in North Asia, particularly in the tech area. And we've put more money into areas that are very rate sensitive, like ASEAN region.
Any sectors globally that you think may benefit from this new macro rate cutting regime?
Yeah, I think it depends on countries. Ironically, I'm going to say some financials, but normally if you were in the US, you'd say, well, financials are hurt by rates coming down. But financials are hurt by rates coming down because their margins can come down. But if that financials in emerging markets are a warrant on the growth of the country, and if rates are bringing better GDP, better consumption, then overall it's better for the banks, as in their books grow, but the margins on their deposit versus their lending rates comes down a little bit. So actually in ASEAN it's positive, in India it's positive, in China not so much.
Okay.
So financials in ASEAN, definitely. We're not ready yet to buy deep cyclicals in terms of commodities. That's always traditionally been a play on interest rates, but that's more to do with the weakness in China growth. And then the other complicated area is normally in this cycle, we'd be buying what I would call, cyclicals in tech in Taiwan and Korea. But because of the AI theme, Ben, they have already run quite hard. So we're a bit more selective there. So really the theme is domestic economies, as opposed to more US driven technology.
We're now in a rate easing environment. Is there any economic or external factor that you're now most concerned with?
I think that the upcoming election and the next political party's fiscal policy will be very, very important. Whether that's to do with tax cuts, tax hikes, how much money is spent, where that money is spent, will be probably more of a nuance on global growth than rates coming down. And, for us at Matthews, that's incredibly important because depending on which party gets in, that will also have different ramifications across